If you're an investor looking for a way to buy a concentrated portfolio, especially in the mutual funds segment, then you may want to consider focused equity mutual funds. With this type of investment, you're restricting your portfolio to a maximum of 20 to 30 stocks. This type of investment can be a good option for investors who are looking for a way to restrict their investment in one particular mutual fund scheme and focus on a smaller number of stocks. Let's understand what are focused mutual funds and if they are the right ones for you. SEBI mandates focused funds to invest in a maximum of 30 stocks across various market capitalizations. However, they can invest across market capitalizations or are free to focus on a particular market cap segment. On the other hand, large cap funds are mandated to invest a minimum of 80% of total assets in equity and equity-related instruments of large cap companies without any restriction on the number of stocks held. Generally, more than 100 shares can be invested through equity mutual fund scheme. Now let's come back to focused category shares. Since the number of stocks in the focused category is capped, fund managers tend to bet on stocks that will surely give huge returns. Srinivas Rao Ravuri, CIO, PGIM India Mutual Fund, says it is worth noting that focused funds can also have a large cap tilt. Thus, investors should look at the style box or the underlying portfolio of a fund to identify the fund's market cap tilt or strategy. Focused funds are meant for aggressive investors who have a slightly higher risk appetite. Let's see what their returns are. In the last 3 years and 5 years, the focused mutual fund has given an average return of 20% and 11%. You might be wondering whether you should invest in those funds or not. When it comes to investing, there are a lot of factors to consider. Investing all your money in a focused mutual fund can be tempting because of the possibility of high returns. But make sure you do your research first. There are a lot of risks associated with these types of investments. So, it's essential to understand all the potential outcomes before making a final decision. Focused mutual funds are better for experienced investors. It is better for new investors to stay away from them. Generally, experienced investors are ready to bear a higher risk. Also keep in mind that in order to reap benefits of investing in such instruments, keep a time horizon of 5 to 7 years. Focused equity mutual funds are considered to be highly volatile. Thus, individuals who are seeking safe investments should explore other options within the realm of mutual funds.